Mr. Chairman, thank you very much. Thank you, both secretaries, for joining us today. Short of overall GSE reform, what steps could we take today, short of that 2-year period that Secretary Geithner mentions, that would encourage capital formation, the return of the private sector into the housing market?
Well, Senator, we begin in our report by highlighting the fact that there are some things we can do to help gradually phase out the government's role, and we have to get these rules in place for banks and investors and the securitization market so there's clarity about the rules of the game in this context. You know, better underwriting standards, clearer capital requirements, better disclosure requirements, better servicing standards, things like that. So those two conditions are very important for getting private capital to come in, and we think we can begin that process right now.
In the instances that you described, that would be an administrative action as compared to a congressional action?
Those sets of reforms we laid out to wind down the government's role and to put in place clear rules of the game for the private markets, most of those things we can do within authority Congress has already given the executive branch.
Senator, there's also, I would add, a number of levers that we point to in the report that we've already begun to take action on as well. FHA has grown from its historic share of the market of 10 to 15% to close to 30%, in the purchase markets over 50%. And with authority that this committee worked to give us last year, we just announced an increase in our premiums of 25 basis points that, in addition to helping to rebuild our reserves, can help to begin to step back our role. I would also point to the loan limits, which we advocate Congress allowing to step back to the HERA limits on October 1st. And we would want to engage in further conversations, particularly around FHA, about what lower loan limits we might want to pursue for FHA as well as the GSEs going forward. So those are a number of other steps we've begun to take.
Thank you both. Hometown Kansas bankers continue to talk to me about the regulatory environment in which they operate, and particularly small community banks. I've had conversations with bankers who say they no longer are making real estate loans as a result of the concern about the regulatory examination environment. I think it'll be a very sad day for particularly rural America, but for America in general, when your hometown banker is not willing or capable of making home loans. Are both of you aware of those concerns, and are there steps being taken to either dissuade the bankers from having that concern or to reduce the reason that they do have the concern?
Senator, you're absolutely right, and of course we hear the same thing from banks across the country. Part of this, of course, is in some sense the natural consequence of the natural response of regulators who, in some sense, were a little too, how should I say, too loose in the boom, and they tend to overcorrect on the crash. And so I think that you're still seeing banks report a lot of concern about the change in the basic environment from examiners. The bank supervisors in the country with responsibility for this are aware of this concern. They've issued a series of different guidance to examiners and clarifications about treatment of commercial real estate loans, for example, to try to respond to this concern. And I know that Chairman Bernanke and Chairman Baer and the acting controller of the currency, John Walsh, are aware of this and are continuing to try to look for ways they can try to make sure their examiners bring the appropriate degree of balance to these judgments and don't overcorrect.
Another point I would make, though, Senator, as well, is one of the consequences that we've seen through this crisis has been an increasing concentration of lending. Today, the top 5 banks account for about 60% of all originations. And I have heard very directly from FHA-approved lenders in many communities, particularly rural communities, that FHA's presence along with VA and USDA is absolutely critical to ensuring that they can continue to be a source of safe, affordable home loans in their communities. And in fact, one of the points that we make in the report is that a risk of option 1 in particular could be that we would have more concentration and less availability for community banks and others to be able to continue lending in those communities.
Before I lose my last 9 seconds, let me ask a broad question. I think there's as you all are aware, the topic of conversation, the discussion, the point that Congress, the administration are in, deals with the fiscal house of the United States. In my view, we are bankrupt or nearly bankrupt fiscally. And I think there's a tendency in this country to see this as a typical Republican versus Democrat, liberal, conservative, whatever the labels are, something that's an academic or philosophical battle going on in Washington, D.C. In my view, there are significant consequences to everyday American standard of living, interest rates, and I would think that if we continue to have a goal in this country of having home ownership, that I hope that you would agree with me that there is a significant consequence to the failure of Congress in addressing the fiscal issues that we face today with rising interest rates. This is, I would like your reaction as to tell Americans that what we're discussing here, the outcome of the debate and the votes that occur in the House and Senate approved by the President, have direct consequences upon our country's and its citizens' ability to enjoy a higher standard of living and to enjoy home ownership. Am I missing something in the magnitude of what we face today?
No, I agree completely. It is a bipartisan imperative that we find a way to put in place long-term reforms to reduce our long-term deficits. Of course, we have to do that in a way that doesn't hurt the recovery or leave us without the capacity to finance things that are critical to our capacity to grow as a country going forward. But our growth prospects will be in jeopardy, short-term and long-term, if we can't find a way on a bipartisan basis to lock in reforms that will bring those deficits down over time, not least because of a potential risk you see higher interest rates in the future. Higher interest rates would be bad for the economy generally, not just make home ownership more expensive.
I would also add that within the direct area of housing finance, important steps have been taken by the conservator of the GSEs to improve their lending. Their current lending has begun not only to improve the housing crisis more broadly, but also to allow them to make good on their commitments to repay the American taxpayer through the agreements they have with Treasury. And on the FHA side, we've taken a broad set of steps to improve our finances to the point where we will actually contribute to the taxpayer in the range of $10 billion this year because of the improvements that we've made in risk management and a range of other areas. So these are critical areas where we can get our own fiscal house in order by responsibly managing, again, on a bipartisan basis, just as you said, to improve government in the way that the President laid out in his State of the Union address and has consistently said. We have to improve the performance of government, and that means an important part of getting our fiscal house in order.
Senator Hagan.